Hello and welcome to the download. I'm your host, Dave Richardson, and we have got stuff happening all around the world. So no better person to have on than my cousin, Jeremy Richardson. He is one of the key members of the RBC Global Asset Management global equity team. And because he's looking all over the world and things are happening all over the world, again, he's the perfect guy to have on. Jeremy, how you doing?
I'm very well, thank you, Dave. Hope you're keeping well.
I am, and as mentioned in the as we were leading up, I'm out on a farm in Quebec, and I know you've got the family farming background. We have incredible talent around the farm. You used to tell a story about farming when you and the relation to investing.
That's right. That's right. I can think of no better example of having an ownership mindset than the working commitment my uncle used to put into the family farm when I was growing up. And I distinctly remember, sitting there with my siblings getting fed, and my cousins, more
More
cousins,
cousins,
Dave,
yes.
around a very large sort of kitchen farmhouse table and being stuffed full of jam and bread by my aunts and my and my poor uncle. You know what farmers like? They're never always complaining, and he was never allowed into the kitchen wearing his overalls and gumboots. So he was sort of had to sit on this wooden chair outside, and take all of his dirty clothes and boots off and stuff. And he was sitting there, I remember, and he said he's been out on his backhoe digger clearing out ditches, and he said he's moaning. So it's not as though the cows know I've done it, he said, and that always struck with me because I think it's a really good example of why we do things when we have that deeper level of commitment, when we have that sense of ownership, right? Because it's very easy for him not to have spent that time, money on the fuel uh, to dig out those ditches to ensure that the fields didn't become waterlogged. But he did it anyway because if he hadn't, then the cows wouldn't have got the nutrition, the grass wouldn't have grown, and the farm would have become less valuable than when he got it from his father Ted. Now, my uncle Michael has passed, and now my cousin Andrew is digging out ditches on the farm, and he's continuing to do that so that when he passes it on to his son Jack, the farm will continue to be a thriving business. And I think this is a really good sort of example of the extra mile that we go to look after things that we really care about. And it's in contrast to that sort of perhaps more transient attitude to ownership you often find in public equity markets. There are people who are trading stocks. It's like the aphorism, the fastest car in the world is a hire car, because you just don't have a sense of ownership. You don't treat it as well. So having a sense of ownership, investing in those great businesses that we like to identify, we think is sort of the best way to go. And so we feel a sense of responsibility, like my uncle on the farm, to try and sort of engage with companies that we own to ensure that we can play our part in making them as good as they can possibly be. And of course, that's in our interest, right? Because who wants to buy a lousy farm? You're not going to get the return on that. Who wants to buy a stock or a lousy company? So if we put the work in to make these businesses as good as we can, then it actually pays off for us as investors. It pays off for our clients, and also I think we can feel good about ourselves because actually we're playing our small part in progress and making these companies better.
Yeah, and it's such a fundamental part of what you and the team do as you're managing assets and you're looking at companies that you're going to invest in, but more, as you say, a better way of saying it is companies that you're going to own and grow with over an extended period of time. And that dedication in so many forms, and I'm sure we'll get into it at some point in the discussion, is that extra boost, and when you can identify that, you're identifying a company that's going to grow at a faster rate, and therefore the stock is going to appreciate over time at a faster rate. So, let
Yeah,
yeah let,
that's right.
let let's just shift gears to what's happening in markets right now. We've seen a new administration come in the U.S. We've had lots of announcements, and lots of volatility in markets. We finally had last night a court in the U.S. has struck down all of the tariffs that were imposed by the administration, and so there's the potential that these tariffs, I guess, just disappear and don't. How do you go about thinking about owning these companies when there's that much turmoil? You see the market pull back 20%, come right back again. How have you managed through all of this as a professional investor?
Yeah, there's certainly been a lot going on, and a lot for us to think about. We've been trying to think about it in two ways: a bottom up and a top down. The top down is really about trying to make sure that we remain within the constraints of the job that we're given to do by our investors, which means to say that we have to remain fully invested. Our investors are much closer to the decision about asset allocation than we are. They've got their own motivations about retirement and the numbers they want to hit and attitude for risk and so on. So we're not going to try and impose our view on that and get in their way. So we try and stick to the job that we're given, which is to be investors, to be fully invested. And given that constraint, what's the best way of allocating resources within the broader opportunity set? And to that end, I think one of the things that we've been sort of reflecting upon is just how much change there has been and how swift the change has been, both in terms of the outlook, in terms of the news flow, the direction of the market, but also within the market. We've seen it regionally between the US and outside of the US. We have seen it within industries because not all industries are going to be impacted by tariffs equally. So it's been very important for us in order to be able to manage that risk to maintain a decent level of diversification. We've never really been sort of like congregating on one side of the boat. We often talk about, if you heard us before, Dave, you'll have talked to us about trying to stay in the middle of the boat, because if you're susceptible to a little bit of seasickness, or you don't like the motion of the ocean, then if you find yourself in the middle of the boat, you minimize that volatility. And so from a risk point of view, from a portfolio point of view, we're trying to sort of stay in that kind of position to minimize the volatility from the things that we don't want. And so we've never been sort of throwing money around in sort of US here, outside of US here, or trying to play the sector call quite aggressively. And I think we're kind of pleased that that's the case, because given the big swings that we have seen, by George, we could have been heroes or we could have been zeros if we had done that. So we've tried to plot a middle course here, and it seems to have worked reasonably well over the very recent short term. So we're heartened by that. And from the bottom up point of view, that's really about the companies themselves and how individual industries are impacted, because we understand that the secret of identifying a great business must start with the essence of a company's competitive advantage. That a business must do something different from its peers in order to win that daily moment of truth when customers get to decide where they want to spend their dollars. And the nature of that competitive advantage is going to be impacted potentially by things like tariffs and supply chains and making sure you've got the inventory on the shelf at the right time. So there's a lot of really boring stuff that has to happen behind the scenes for companies to get in a position to win that moment of truth when customers get to decide. And if you don't have the inventory on the shelf because your supply chain's out of whack, then you're not going to win. And for most of the time, things like supply chains, that they are absolutely fundamentally important, but 9 times out of 10, these are the sorts of issues that don't tend to pop up in some quarterly board meeting. The chairman and the chief executive don't find themselves sort of coming under pressure as a result of supply chain management. But occasionally that they do pop up, and actually the businesses which have got better management teams, we tend to do a better job of able to manage around some of these issues. And I think a really good historical analogy to this was what we saw in the pandemic. Yeah. Because you remember at that period, Dave, there was a significant disruption to supply chains. And those businesses who were who'd done the work, who found themselves with more flexibility, proved to be more resilient, and they were did a wonderful job, many of them, in actually keeping their customers supplied during a very difficult and trying period of history. We have been sort of leaning in that kind of direction, I think, with the news on tariffs, and I'm pleased to say that from the portfolio's point of view, by luck or good judgment, we've managed to avoid some of those industries which have had the biggest exposure to the potential tariffs. So that's been heartening to see. But nevertheless, we have been doing the work from a bottom-up point of view to work out who's impacted, who's not impacted. But as you rightly say, this is a very dynamic situation. The news keeps changing, and the most recent news that we're trying to sort of comprehend is the scenario, which is essentially saying that it's these things drop away. I know when we were last with you, Dave, I had a slide, I think, which showed the sort of the steps to liberation, as I called it, rather than stairway to heaven. And and I did toy with having one of those steps on that stairway to liberation being sort of what you might call sort of the Bobby Ewing scenario, which is essentially you wake up and it was all a bad dream. And it kind of feels as though today we're sort of like, what does equilibrium look like? But I think one of the things we're probably, as investors, yet to fully comprehend is where the consequences of this court decision on other aspects of the administration's agenda. So, in particular, the revenue that tariffs were supposed to generate would go some way to funding potentially tax cuts as we came up to the midterm elections, and go some way to reduce the size of the budget deficit, which is being increased because of this sort of the big beautiful budget bill. And now we have the departure of Elon Musk from the administration. Now we have the abandonment of tariffs, maybe temporarily. We'll wait and see. But it raises all sorts of questions about the policy goals of the current administration. And I think for investors, this is a new level of uncertainty that we haven't had to deal with so far.
Yeah, we should go back and refresh the many members of our audience who would not remember Bobby Ewing. And that reference, I didn't realize Dallas got over to the UK back then. This was an evening soap opera, and they basically needed to reset. They'd done an entire season that they just wanted to disappear, so they just all of a sudden it was a bad dream, and they carried on with the show from the point that they wanted. And again, that is kind of, you look at what's happening in the courts in the U.S. and so many of the policies that have been done by dictate, right, by the stroke of the pen, the presidential decree, that courts have blocked those policies, and so you're left kind of sitting here today with like, well, it's like it didn't even happen, even though of course it did. And then what you were talking about with management teams, and this I know is a core part of what you do, you and the team as you're making your investment decisions, is you spend time with these leadership teams, and very clearly when you go through a period like this where there's things coming at you every day, an effective management team is going to make a huge difference. So knowing and understanding through, again, sometimes it's from a long-term ownership. You're spending a lot of time with these people, so you know how they react in a crisis. Other times you can evaluate at a distance when you're deciding whether you're going to buy or not a particular company. You can see how they've reacted through these different circumstances that have been thrown at them, and it really is amazing. I don't think most investors really think. Although we all work somewhere and we see the effectiveness of our manager or our the executive team at our company, and you see how much of a difference it makes in a crisis, but not just in a crisis, but over the long haul. And I actually had the opportunity one time when I was over in London to go out with one of your colleagues and watch what you do in terms of getting that deeper understanding of the company. I also got some chocolate samples. It was a good visit, but it's really incredible to see the due diligence, and this is such a big part of what you and the team do, because you're looking for things, again, not just the empirical measures, but other things that you see management do that builds equity and builds value in the company over time. Maybe you talk about that.
Yeah, it's a really good point, Dave. Thank you for bringing that up. I mean, we often talk about trying to understand the personality of companies, because companies, they're social organisms, right? They're made of people, and it's people collaborating together in order to try and deliver a better outcome than what they had the day before. And that's where the value gets created. It's that combination of labor, capital, and innovation that comes together to add real value. And it wouldn't happen without the people. So understand the personality of the companies, you understand the culture of the organization, you'll get a lot more comfort around that. People talk about culture as being the sort of things people do when nobody's looking. And obviously, we can't be with the company all of the time. So if we have some comfort that the culture is the right culture for the industry, then when something untoward happens, something unexpected happens, then we have a degree of reassurance that the management team will treat that with the degree of significance that it requires and put in place strategies in order to be able to manage that. And I think examples of I mentioned about the pandemic earlier, or about tariffs, or you might have things that come from left field. It might be a cyber attack. It could be sort of a political event. It could be the eruption of a volcano somewhere. These things are sort of sent to try us. But when those occur, companies that are more resilient, that have actually a strong corporate culture, we think actually would be do a better job of managing their way through that. Now, of course, there is no one common culture that you're looking for, right? Because businesses vary quite significantly. I think a really good example of this might be if you're running a railroad, for example. It's really important if you're running a railroad that you have to huge respect for safety and timekeeping. Those are critical deliveries, unless you're not going to be able to have a successful railroad, right? But if you're managing an advertising agency, well, actually, you don't want everybody to think exactly the same thing. You want that diversity of thought, sparking of different ideas. And it's a very different sort of set of values that you're trying to inculcate within the organization. So, making sure that you've got the right culture. Obviously, you want businesses to behave in an ethical way, that they actually respect the needs of all of their stakeholders, but actually making a considered a judgment that actually this is the right culture for this particular industry, and this gives this team, it's rarely individuals, it's usually a team, an opportunity to deliver superior results. And because they have the resiliency that we're looking for, they'll be able to manage this business effectively on a day-to-day basis, but also position it strategically for the long term. And we've owned some companies in our portfolio for well over a decade. And I promise you, there are some of those businesses, they look very different today than when we bought them 10 years ago. And part of the reason why we've continued to be shareholders in them is because the management teams have been able to capture the opportunities as they come along. It's amazing. Like, good stuff happens to good companies, good stuff happens to good management teams. And like the aphorism about playing golf, the more I practice, the luckier I get. The more you sort of invest in your business, the more you develop that stronger culture, the more opportunities you seem to get.
Yeah, because as you say, companies are made of people, just like Soylent Green. Here's a reference for you from if we're going to go back to the 70s. But yeah, I mean, again, for people who have, you just think of it yourself. If you think of different places that you've worked throughout your career, or even if you work in a great place and you have friends or family that work somewhere that doesn't treat their people the way that they should, and you hear them around the dinner table at a family gathering. They say, "Oh, geez, it's awful where I work. Where they do this to us, they do that to us," and then you're sitting there, "Oh, I work for a company that really takes care of their employees, that wants to help them build and grow, just like along with the company." The difference in that environment, the difference in employee satisfaction, and then commitment to driving results. It just makes so much sense, and it's again, it's always been. And if and go back, and we've had Jeremy and his colleague Habib on previous podcasts. If you want to go back, click and subscribe to the podcast wherever you get your podcasts, and all of those old episodes are there. We're on YouTube here, as you can see. The dashing Richardsons. We're a very handsome family. So if you want to see us on video, not just on audio, listen to us on audio, you can subscribe on YouTube and leave us a 5-star review. We always like that stuff. So Jeremy, let's just finish off, because I know you've had Nvidia as one of your holdings for quite some time, NVIDIA happened to be out last night with an earnings report, and maybe comment on that. But when I saw you last, you were talking about the whole evolution of the companies that are going to be part of this incredible wave of artificial intelligence that is going to sweep through the economy, and how you're kind of shifting where you're placing your bets, or not placing your bets, but where you're allocating assets. So maybe take Nvidia and then go from there.
Yeah, absolutely, gladly. And it's an astonishing set of technologies that seem to be coming at us at pace. The NVIDIA results last night, I think, underlined that, because I think for me, one of the key things I took away from them is the almost the acceleration that we're seeing in the usage of artificial intelligence. We know about the clever things that these large language models can do, and we can see and hear about all the capital expenditure going into the industry from the so-called cloud computing companies as they sort of race to develop superior large language models. But the thing that is changing and really helping a lot of these technology companies now is the way in which this artificial intelligence is being adopted by users. In the industry, this is called inference, and essentially it is, every time we might engage as consumers with an artificial intelligence model, we ask it a question, that behind the scenes, the model will take that question and try and answer it. And there's a lot of sort of clever maths that goes on behind that in order to deliver the outcomes that we see. That process requires computing, it requires chips, and it's a different flavor of sort of artificial intelligent activity. Whereas the training is, large runs of activity in order to try and develop the core competencies within the model. This is actually taking those competencies and turning that into useful output that you and I can actually use, Dave. So, and it's the acceleration of that artificial intelligence, which I think has sort of come through in spades in this in the NVIDIA results, and it's led to, I think, it's put to rest, let's put it this way, some of the concerns that were around the industry around the end of last year into the early part of 2025. And there are certain anecdotal data points that we're paying attention to about the increase of this inferencing. So very excited for the future about what the technology could bring, and focusing our attention as investors on those companies who have something unique that they can bring to the party. And I think NVIDIA is one of those companies, but it's not alone. There are other companies that we own in the portfolio in terms of chip hardware, manufacturers or designers of chips. So Taiwan Semi would be a good example of that, or Broadcom, who are sort of related manufacturers or partners in this particular segment of the industry. But as we sort of look ahead, then what's the best way of tapping into this increase of activity? Well, we think it's actually about moving up the value stack, as we like to say, and shifting our emphasis from the manufacturing, from the hardware, to actually the software. And so we've been putting capital to work in names like SAP, in Salesforce, in Intuit, and these are all businesses that we think will be helping to deliver those artificial intelligence solutions to their customers. In fact, we had very good results from Intuit earlier this week, actually. So this is a company that many of our viewers and listeners may be familiar with, particularly if, like me, you have to pay tax every year. Then having a tax accounting software from Intuit, it can be very helpful in being able to do that if you're running a small business. And things like QuickBooks, again, can be very instructive. And many of us might find that when we're doing our tax return, we could do with a little bit of help. I know sometimes I could. And actually having an agent, an AI-driven agent there, to be able to give all that very timely assistance that I need, can be invaluable, particularly because I tend to be doing this thing it's probably sort of at the weekend or the early hours of the morning when sensible people aren't up. So this is actually, we think, enhancing the competitive advantage of some of these companies. There is a lot to be gained, I think, as a society from artificial intelligence. It will enable companies to become more productive. It will allow people to become more productive. And that's good for society, because the more productive we are as people, the more we can afford to be paid, and that's how wages increase over time, and that's how society moves forward. So we shouldn't be afraid of artificial intelligence from that regard, because it will be an accelerant of GDP. But in the same way that electricity was transformational for many industries, and artificial intelligence we think will be too, nobody today will say, well, look, you should invest with us, right? Because we have electricity. Everybody's got electricity. Everybody will be using artificial intelligence. So the clever bit is to work out for whom artificial intelligence is transformational. For whom does it actually enhance the competitive advantage? Because for others, it will sort of average down. Everybody will have access to wonderful tools. But for some, it will make a real difference. And so we're trying to be very selective about the software companies that we're looking at and we're choosing to invest in, because we're focusing on those that we think will be benefiting disproportionately versus their peers because of the way in which they're implementing these artificial intelligence tools.
Yeah, and a great way to think about those earnings yesterday, I think, is that the NVIDIA report and the strength of it and the breadth of it really just reminds everyone that this is a theme that is ongoing. It is something that is happening. It's going to continue to evolve. And then in the Salesforce, because as you mentioned, you also hold Salesforce. Salesforce had their earnings yesterday, and that's kind of the production.
Yep.
NVIDIA is kind of the plumbing, and Salesforce is the water coming out of the tap, the actual result that you see, and actually giving you something that helps you. And again, both firms reporting show what and we're just at the tip of the iceberg of what's going to happen with artificial intelligence, but how transformational this will be and how important an investment theme it is. And you and the team caught it, and you were on it very early, and that's why you've had so much success. And Jeremy, it's just always great to see you. Hopefully, we've had a lot of chances to bump into each other this year, with you coming over our way and me going over your way. Looking forward to seeing you again in the not too distant future. And thank you for always being so gracious with your time and joining us.
It's been an absolute pleasure. Anytime, Dave.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only, and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.